Nick Tippmann. Welcome to the Vertical SaaS Podcast. Excited to have you on, man.
Yeah, pumped to be here, Gavin. Appreciate you having me and looking forward to a great conversation.
Likewise, likewise. Well, for those that are watching, listening, many will probably know who you are, but for those that don't, why don't we go back to the beginning? You've had quite a, standout career, shall we say? One of the sharpest GTM operators turned investor, took Greenlight Guru to tens of millions of ARR, 120 millions of ARR. It'd be great to not just hear about that journey alone, which we'll get into. But yeah, maybe just going back to the beginning and walking us through your journey so far.
Yeah, for sure. Like I said, excited to be here. I'm a founder operator at heart. Grew up starting businesses. Started a couple of companies after college that didn't end up reaching their full potential, but were great learning experiences. Today, I'm the founder and managing director at TipTop Ventures. We're a pre-seed and seed stage vertical software and vertical AI specific fund, leveraging my background as CMO and founding team member at Greenlight Guru, vertical software for the medtech industry, help med device companies get approved by the FDA, the EU, Health Canada, and then keep their devices compliant once they got to market. We had an amazing run there over 9 years, as you mentioned, scaled to tens of millions in ARR, raised over 120 million from private equity a couple of years ago. Had an amazing run. Company's still doing fantastic. Greenlight Guru, and yeah, transitioned out a couple of years ago and been doing TipTop full time now for almost 2 years. Um, we are actively deploying and have made 12 investments out of the fund to date.
Nice. And what drew you to leaving? Because you've always been an entrepreneur, as you said, founder, president at TipTop Electronics and Games back in 2006, where you built an
Yeah,
e-commerce platform.
yeah.
Like what? Because you've always had that entrepreneurial spirit, that kind of lead from the front. Why transition into investment?
Yeah, for sure. It's a great question, and it's really the culmination of a 15-year career goal of mine now at this point. I come from a family of small business manufacturers in the Midwest. We didn't have a lot of tech around me growing up. Startups, venture capital, angel investors, these were not normal terms that I was around growing up. And so when I was studying entrepreneurship and marketing at university, I came into this whole tech startup world my senior year of college and was like, holy smokes, this is what I've been looking for my whole life. And ended up diving in and finding some gentlemen that I think your audience will likely be familiar with by the name of Fred Wilson, Brad Feld, Mark Suster, Paul Graham, some famous great investors, and many of them former founder entrepreneurs turned investors, three out of the four at least. And so in my head, I thought, man, that seems like a great career path. Like, let's go be a successful founder, operator, have some success, and then when we're in a position to be able to serve and give back to other founders and find something to do for the long term that really doesn't feel like a job to me at all. Like being able to have the privilege and opportunity to meet and talk with and serve some of the top, most ambitious, best founders in the world, going after some of the biggest ideas and making their dent just seems super rewarding and exciting for me. And it's something that I feel that I can do for the next 20, 30, 40 years. So that's kind of my journey and what's got me excited about it.
Hmm. And unpacking the green light guru, because you walked in, no product, no revenue. Like, what did day one look like when you stepped into that role, founding member of head of marketing? Like,
Yeah.
what did that look like, and what was the moment you realized you had product market fit? What told you you had that? Yeah.
Yeah, finding product market fit, that's definitely an evolving journey. But no, when I came in, we were pre-product, pre-revenue, no website, no product. And it was figure it the F out. We had an amazing vision, amazing co-founders, and a big opportunity ahead of us, and we just had to get to work. Um, how do we know we found product market fit? I think it's an evolving journey, but like most vertical SaaS companies, we started with a unique and compelling wedge, and our co-founders had a unique right to win and earned insights into the industry, having been in it for the last 20 years and ran many of the processes that we eventually ended up building SaaS software for in Excel spreadsheets and manual disjointed systems. And so we focused on a wedge product that was very specific to medical device design controls or medical device design development in design controls, and built something that was unique that none of the other horizontal platforms and quality management software had built. And that was kind of the workflow that's at the beginning of the design and development process. And then we were able to expand from there and build risk management and document management and continue to scale across the value chain. And so when I think about product market fit, I think it's evolving. It's not a one time place in time where you kind of stamp it. It's always moving with the market, your customers' expectations, competitive opportunities, technology opportunities. And so yeah, I don't know that I would give an exact moment, but you can feel the pull from the customers and the customer feedback as you get it out there, and people start getting use and value from your product. And there's a point where it becomes repeatable, and you can teach other folks that not just our founders, the ones selling it, and hire some AEs and be able to build a repeatable process. And once you're able to get something that is repeatable, that does start to feel like you do have some product market fit.
Hmm. I ask it because I interviewed a founder yesterday for another episode of this podcast, and he said to me, which I thought was interesting. We had our biggest competitor and some of our potential and existing customers in the room with this competitor, and all everyone could talk about at the table was this company, not the what company we're in the room with. And for them, they were just like, "Well, that's it. Everyone's talking about us, and they've got the biggest vendor in the room in this space, and they're all talking about us as product market fit." So, just wondered if maybe there was a moment there. But how did you get to your first million in ARR? Like, was there any specific channels or GTM tactics that stood out when you look back on it now? Because in the moment, you're just executing, right? But when you look back on it, maybe sometimes you can be like, that was a really great tactic we done, or that really stood out for me. I want to keep that in the playbook.
Yeah, for sure. Yeah, the first million ARR was fun. It's very scrappy. It's doing a lot of things that don't scale. It's leveraging your network and referrals. But to get past those first couple hundred K in ARR into a million, and when we started the company back in 2013, um, the playbooks have evolved a bit from them, but honestly not I don't know. The core principles I like to think are actually more similar than they are different. The tactics maybe are a little bit different. But I like to say when you start out, well, really, all marketing has two goals: to either change behavior or manage perception. And changing behavior is really around direct marketing, demand gen, revenue generation, and managing perception is around brand. When you're just starting out, you don't have a brand. Brand is not your design, logos, colors. It's what other people think about you. And if nobody else knows about you, then you don't essentially have a brand. So you really need to lean on your direct marketing and the revenue marketing. And so when you look at that, I think about things in inbound and outbound motions, paid motions versus organic. Um, I think around that time, going paid and going to Google and early Facebook was a common go-to-market strategy and something that we tested. But what we found, and what I think a lot of other vertical software companies have found over the last decade plus, is that in niches, it can be harder to get the volume that you need from any sort of paid traffic sources, because you're going after such a small subset of another industry, and life sciences, med device engineers, or manufacturing, medtech manufacturing. Like it gets down. So we tested that out. Didn't have a ton of success. But then I really leaned on some of my experience and leverage running a media company prior to Greenlight Guru. Built a media company focused on startups and entrepreneurs outside of Silicon Valley. And what I realized was that around that time, it was becoming common knowledge that every company is a media company. I think that 10 years, 10 plus years later, that's even more true than ever. But we were definitely early along that trend. And so I really took the strategy of building the largest media company in the med device space inside of Greenlight Guru. And what I learned is that it's a lot better to monetize that audience of the media business selling 20, 30, $50,000 a year software than 200, 300, $500 one-time ticket sales, but the motions on how you do the two are pretty similar from a marketing and top of the funnel. And so when we started without the brand, we actually started to leverage other people's audiences, and we took a founder brand strategy. And so our founder, John Spear, was a medical device expert, been in the industry for 20 plus years and had all the domain knowledge and experience. And when I looked around back then, there were founder influencers, VC influencers. Twitter was really big, but when you look to the med device space, there was no such thing as a concept of of an influencer, a B2B influencer. And so our initial strategy was actually to create a founder brand around John and leverage his insights and experience. And so we put together an inbound marketing strategy that propped him up and did a bunch of guest posts on industry publications, started our own blog, started our own podcast, started doing webinar series, and that was kind of the initial kernels of the inbound marketing engine that we were able to build that enabled us to scale to that tens of millions in ARR, with essentially for most of the time lower than a 12-month CAC payback period, which allowed us to continue to bootstrap because we were so capital efficient.
Ah, that's class. I love that. I love just so brand conscious from the outset and then building that around the domain expert, the founder. Yeah, yeah, that's great. And how did the story end for you again at Greenlight? There was an acquisition, right?
No acquisition, but we had private equity come in, and so we brought on a capital partner, which we raised $120 million from JMI Equity. And that was their fantastic partner. Business still going great, running today. I stayed on for a couple of years post transaction.
Hmm.
Had a great ride when they came in, ended up leading product interimly as well for a year, helped ideate, build, launch a new product line, and then help hire our new CPO, and then was leading strategy and corporate development as well. And we had lined up a few acquisition targets across the value chain and had started executing on that strategy and acquired a company out of Denmark that. I ended up having a lot of fun going over there and working with the team and integrating that team and that product line into our business. The markets started to turn over a little bit. If you remember back in 2022,
Yeah.
late 2021, it became pretty clear to me that we weren't going to execute on the rest of the acquisition strategy there. And if that was the case, I was more or less going back to my quote unquote normal CMO job that I've been doing for the last 9 years. And we looked at the business, and it made sense to consolidate sales, marketing, and CS under one revenue leader and bring in a CRO. And felt at that point it was just me and the founder CEO left from the original founding team, and felt like a very natural transition point. And so help hire that individual, transition out over a 6 month period, and yeah, that was about 2 years ago now.
Like a true pro, like a true pro, leaving it in a good state. Um, Building revenue machines, you've just walked us through a little bit of that early day playbook, and you alluded to it moments ago in saying that it's just really hard to get the volume in these niches. Like, but what's different about including that? What's different for you, do you think, in vertical SaaS versus horizontal? And what do you feel or see that most early stage founders get wrong about building a repeatable, scalable GTM motion?
I would say what most people get wrong, and it's kind of counterintuitive is actually the more specific that you get and the more narrow you go on your ICP, the better. Rather than you would think expand your ICP, give you more opportunities, expands the potential opportunity. But what you find is actually the more specific, the more that you're able to resonate with people, your close rates end up going up, your trust is up higher, your referrals go higher, the word of mouth. Pretty much everything gets better when you get more narrow and get more specific and talk to specific people rather in generalities. And so I would say that's the most counterintuitive and common point that I see people getting wrong is that they just want to go too broad, and you really do need to niche down and win in a specific area and then earn the right to expand from there.
Hmm. How do you think about category creation? Like you built the medtech QMS, basically. I think you said the last time. Like, how do you think about that now, from scratch?
Yeah, category creation, that's a good one. It's important. It's not for everyone. I'll say I look at category creation as a product marketing exercise and really a positioning exercise with a specific framework around it. And in some cases, it does make sense to create your own category. In some cases, it may not be the best approach. You may want to do counter positioning. You may come in with a unique angle. But in the cases where category creation does make sense, like in Greenlight Guru's case, one of our biggest opportunities, concerns, challenges was educating the market on why, well, one, why you need a med device specific QMS rather than a general purpose QMS. And so we really wanted to look at how do we differentiate, how can we, and then the other part, sorry, the other part of it was um, we needed to show that quality could actually be a competitive advantage and wasn't just an insurance policy essentially or an afterthought or on the back burner. And so why we decided to create the medtech QMS category is because we needed to differentiate and educate the market and let them understand that quality can be a competitive advantage and that medtech quality management was different than other generic manufacturing quality management because it's regulated and because of the stakes. If somebody's building a new pacemaker and designing and bringing that to market, like you want to be pretty damn sure that that thing's going to work when it's 180 degrees outside and when it's negative 20 degrees outside, right? God forbid something goes wrong and there's a malfunction and somebody's hurt or worse. You want to be able to audit that and be able to look to the documentation and understand were there the proper risk mitigation strategies put in place? What went wrong? Is it a one-off unique anomaly, or is it a systemic issue that needs to go back? And the stakes are just higher in med device, and there's specific regulations and processes that you need to follow. And so it was important for us not to say that we were just a new and modern QMS, but that MedTech QMS was fundamentally different and something that hadn't previously existed before. But and in our case, that made sense. And in some cases, it may be way more of a lift than you need to go to, and you really should just do some counter positioning or other messaging and positioning tactics on how you would position against the incumbents. There's a lot of factors that you can see running through my head here without giving a straight answer, because it also matters the stage of company that you're at too. So maybe it won't make sense for you to start out day one creating a category, but by the time you are at tens of millions in revenue and you are continuing to expand across the value chain, and you do have a more all-in-one complete product, maybe that's the proper time. And so it's an evolving thought and discussion to have around creating a category. But in our case, it did make sense, and we were able to be successful in that and get the way QMS or MedTech QMS was never a large enough category to have Gartner covering it, but G2 and other places like that were covering it and did end up creating their own grids and whatnot. And so we were successful in creating that category.
Nice, nice. Maybe it helps if you hone in on a certain stage or a certain moment on that journey. And you've talked before about alligator blood. What does that mean?
Yeah, alligator blood. That was is a huge part of I assume part of the culture at Greenlight Guru. It was really our ethos. And so we had our mission, vision, values, be number one in the world, improve the quality of life. Um, and alligator blood was really more about how we embodied ourselves. And blood can kind of have a negative connotation. You think this hard charging culture, but really just what it means is it's generally a poker term that the best poker players won't give up when they're the short stack at the table and know that they still have a fighting chance and will keep mentally prepared in the game. And then also when you're the big stack at the table, you're not afraid to throw your weight around and to bully the rest of the table and go for the win. And so alligator blood is really just around this mindset of I like to think about it like grit and resiliency. We know that startups are effing hard. They're a long journey. It's a marathon, not a sprint. There's going to be a lot of ups, a lot of downs, a lot of really, really highs, and a lot of lows. And you need to be prepared mentally to take those blows. And it's not just the co-founders or the founding team or the early team members. That's something that continues as you do scale from 1 to 10 and beyond in ARR. And so that was important for us to and our founder CEO to really infuse throughout the culture and really came from his learnings of 20 plus years building businesses previously and learning at the end of the day, yes, product is really important in strategy and tactics, and you have to have all of that right, but the second product of your company outside of your product is your culture, and you need to think of it and treat it just like a product. And so that was one of our key features.
Nice. I love that. I love that. I never actually knew what it meant to you, but I just referred it in a previous conversation, I think many, many months ago, and took a note of it from my fancy AI note taker. But moving on from Greenlight Guru, thank you for walking us through that journey and getting a bit more insight into what that looked like end to end. The case for vertical SaaS was one that I wanted to chat with you about because, again, when we connected months ago, I felt that my website was out of date and I only launched Zanata a year ago as a vertical SaaS recruitment specialist, and now it feels like that term is maybe redundant already. I don't think it is, right? But for talking sakes, like, what's your take? Are we at peak vertical SaaS? People are saying vertical SaaS is done, SaaS is dead, AI is going to eat SaaS for breakfast, all that stuff. Like, what's your thoughts on it, or are we just getting started?
Well, we're definitely just getting started, and I like to think of it more as a as an evolution of vertical software and vertical markets. And so TipTop's high level thesis and how I view the transition in vertical software these days was that vertical SaaS 1.0 was traditional workflow software. It was bringing on-prem software into the cloud, and companies like Viva and Autodesk are some of the canonical winners and examples of those sorts of companies that built amazing workflow software for specific industries like Viva with pharma. And then came along, and around that time, that was the mid 2000s. I think Viva was founded in 2004, 5, 6, somewhere in that time frame. Vertical SaaS 1.0 had a great run for a decade, 15 years. Then around probably about a decade, and then around the mid 2010s, we saw the emergence of vertical SaaS 2.0. And really, even up to maybe 2020 or so, vertical software investing was still considered pretty contrarian. The conventional wisdom in VC land was that vertical SaaS TAMs were too small to support venture-backed outcomes. Some of the canonical examples that proved that wrong were the winners of vertical SaaS or are the winners of vertical SaaS 2.0, which I consider workflows, software plus fintech. And so the big example and winner there being Toast in restaurants with their POS product.
Yeah.
Something like 90% of their revenue these days comes from their fintech and different ancillary products outside of the core software alone. Service Titan, another example, they just went public back in December, doing really well. You look at their S1, it's about 50% of their revenue these days are coming from their fintech products. And so, what the VCs and the markets have seen from that was that essentially when you add the fintech components onto the workflows, you essentially 2 to 5x the size of the TAM that you're going after with the fintech opportunities. And now we've entered what I like to call vertical software 3.0 or vertical AI, which is the next evolution, which is still workflows, still fintech, but now you add AI on top of that. And sometimes AI can be doing the work and completing the work product, but you'll still have both humans and AI agents that are running the workflow in the fintech software. Um, and how this is being sold still feels a lot like enterprise software. Yes, the pricing models may change. Maybe we're moving away from a pure seats-based model, but we'd already moved to a transaction-based model, particularly in a lot of infrastructure companies like Twilio and SendGrid that was acquired by Twilio. But we had this idea of a transaction and usage-based model, and now with AI, you're just pushing that further to owning the actual outcome, and you may be actually selling outcomes at the end of the day that you're responsible for. And maybe you own the software, maybe they still own the software, and you charge them by the outcome. But it's really on this spectrum of outcomes and kind of a matrix of different pricing models. But enterprise software and selling to vendors isn't going away, and I think that's what's staying the same. The tactics about how you go about that and your pricing and packaging and all of that is evolving. But we are definitely in a new era, and that's what I consider. I don't know if the SaaS vertical SaaS nomenclature is outdated, but I'm moving with the vertical software 3.0 and vertical AI, and then we see four, five, six different themes inside of vertical AI that we're excited about.
Well, that's a great walkthrough of the past three phases, actually. Um, how do you spot AI washing in this new era, the rise of vertical AI? How are you spotting AI washing versus real traction, defensibility at scale versus as I say, AI washing a UI, a wrapper, an LLM wrapper around something that's already been kind of looked at, but just by traditional software that now these wrappers can do a little bit better. But there's no category defining there. It's just a bit of an add-on. Feels a bit lazy. It probably feels like I could jump on Lovable and do it myself. I don't have the time, but it feels like we can all build something now. So how do you spot between those two differences?
Yeah, the what we've learned about quote unquote AI wrappers over the last year is that I think that wrappers can be a great strategy and can be a really interesting, compelling wedge. I think what it comes down to though is what's your phase two, what's your phase three strategy? Where do you go from that initial wedge? And yes, it's never been easier to spin up a new MVP, but to bring enterprise grade production level quality software and AI to market is still a difficult challenge, and we still have ways to go. And so when you look back at some of the more traditional moats around data and workflow
Yeah.
and ecosystems and brand, domain expertise, a lot of that still rings true. And so, what today it's easier than ever to come up with a compelling wedge product, but how you grow and differentiate from there is really what's going to make the difference. And so, big part of our diligence process is not just diligencing what's the initial product today and what market are they in today, but how can they continue to expand and grow and what's their phase two and three and vision to go from there and to go from that single point solution product into a multi-product platform that can eventually become a system of record or a system of intelligence slash system of agents over time which then builds in the workflows, builds in the data, builds in the integrations, builds in the ecosystems, and all of the things that you would see with traditional moats. And so, yeah, I guess the way I look at it, I don't think of the AI wrappers as so derogatory or a bad thing. I think it's an interesting strategy to get started, as long as you have a bigger vision from there to build in some more of those moats and defensibilities over time. So yeah.
I mean, you've invested in companies from legal to, I mean, what's your portfolio consist of right now? We know GCAI is in it. You and I kind of got talking about that months ago. What's the diverse? What's how diverse is the portfolio in terms of industry?
Yeah, we've got some in healthcare, we've got legal, we've got home services, we've got education, we've got ag tech, um, we've got SMB. So pretty, we have 12 portfolio companies at this point, and yeah, a good smattering across industries.
Hmm. And what's your advice to these companies? Maybe you can't say too much because look, it's the playbook, but ultimately we talked about going beyond the initial wedge. Data, workflow depths are still prevalent, but like in the age of building long-term defensibility and vertical AI, I feel like speed is it still a moat, or does it just buy you time to build one? I don't know.
Yeah, no, speed is absolutely, I mean, execution is everything. It's as important as anything. Yeah, so what we advise and look at our portfolios companies, it's like what is your wedge? Is it compelling? What's the initial market that you're going after? How big is that market? How much room do you have to run in that market? What are the adjacent opportunities? How big are those adjacent opportunities? Map the workflow of your users, understand their full value chain, understand what's upstream and downstream of your workflow, where's the data going? And both a product development roadmap and strategy, and then a go-to-market strategy that's going to help you extend into other markets, into additional products, continue to grow ACV over time, continue to be the or continue to build more and more of the core workflows for your users so that you are the dominant platform that they're engaging with every day, that they're actually running their actions in, and you're not just a dumb database, if you will, at the end of the day, but people are actually going into your software to do the work. Um, and yeah, the faster you do that, the better, because back to our AI wrappers, or your AI wrapper question and comment that yes, it's never been easier to spin this up. And so competition is the greatest that it's been, and one of the ways to combat that competition is simply to grow faster and to build more.
Hmm. And and I guess when you are evaluating a startup, as you said, those are the metrics, those are the things that you're assessing whether they can earn that moat, not just the race to the MVP. But like, what do you think? What's not appealing anymore? Like, what in terms of numbers, in terms of market sizes, like what is just something that is not investable for you at the moment?
Yeah, it's a good question, and the bar is definitely going up. I don't know if you've seen Andreessen put out a piece recently on kind of the new benchmarks of what's working in enterprise SaaS and enterprise AI, and the 0 to a million in ARR in a year is not the benchmark to go raise a Series A anymore. The
Business case.
marks have gone, yeah, two, three, five. The top companies are going, yeah, 0 to five, I believe it is, in under a year. The top quartile companies in AI, and so the bar has certainly gone up.
The
And
founder I interviewed
remind me.
yesterday, he done 1 million in 2 months.
Yeah, it's crazy some of the numbers that we're seeing out of these companies, and yeah, the canonical examples of Lovable and this idea of the lean startup, and how fast these companies are going 0 to 100 million in ARR is truly impressive and yeah, inspiring.
Yeah, Yeah, it's crazy. It's crazy. I asked him that yesterday. How quickly did you get to it? And he was like, just under 2 months, but we'll call it 2 months. It's like wow.
Wow.
And that's a legal tech.
Nice. Yeah.
What's the one vertical you think's wide open right now and ripe that we're probably not talking about as much?
Yeah, it's a hard question to answer because the way we look at it is that, or our view is that every industry and every role is dramatically changing, and so some categories are getting more investment and some less than others. But what we're really looking for is where are there opportunities to build a product that didn't and or couldn't exist 1 or 2 years ago, pre LLMs and pre Gen AI. And then today, more and more cost savings or time savings is becoming table stakes. And so, how can you build a wedge that generates more revenue for your customers? And so, one theme or idea that we're really excited about that kind of fits this is voice AI. So, you think about um, I don't know, barbershops or dentist office or tennis club or pickleball clubs or anywhere that you have people that are calling in and you need to have a receptionist. And that receptionist today is maybe there 9 to 5, takes an hour lunch, has to do other work as well. Whereas if you had a voice AI product that's answering phone calls 24/7 for you, you're going to be capturing a lot more revenue. If that voice AI is trained on the world's best sales script and knows to offer cross sells and upsells and has a cancellation process that they go to, they're likely going to be better trained than the high school intern or associate that you have working there in their summer job that is just there for the paycheck. And even if they do a great job, there's only so much training that you can do. And so that's one of the areas or one of the patterns that we're seeing that we're really excited about. Um, when you push into to specific industries, like um, I think the obvious use cases with AI is where you're seeing a lot of the greatest growth.
Yeah.
And so like the coding platforms, obviously AI is amazing at coding and language. And so you the coding wars are here all across the board. I think you're seeing very similar dynamics play out in legal right now as well. Similar dynamic. You need to digest, get the context, read a whole bunch of documents, take all of that information in, synthesize it, make recommendations and actions off of that. What is AI really good at? Gathering, synthesizing a lot of data and providing an output. And so, yeah, those are kind of two of the areas that we're seeing. And then another one that we're excited about are really just compliance and regulatory use cases, areas where you need voice AI to, or I mean, AI to be listening to phone calls for compliance. And today that may be an army of people, say in financial services for compliance that have to listen to every single call and flag for any non-compliance. Well, AI is really great at listening to large amounts of calls over time and checking that transcript and seeing if there are any areas in non-compliance and flagging it. So there's a lot of use cases around regulatory and compliance that we're excited about as well.
Mm. But there's no legal privilege. Did you see that?
Yes, I did see that.
That's
That's
quite
not
wild.
not not my area of expertise to dive into, but I was at a dinner with a bunch of um, GCs this week, and it certainly was a topic of conversation.
Yeah, the legal tech one is a space, as you know, I love. I'm very invested in insurtech and legal tech, and of course, I'm doing some work in many other industries, but those are probably my two big wedges and have been for a long time. So I just found that quite fascinating how, for the past 2 years, lawyers have been dumping all this shit into this LLM, and none of it has got legal privilege. It's crazy.
Yeah, most of them at most of the law firms and the general consensus without sharing any names or any confidential information from the dinner there, was that most of them are not using LLMs, and they need to use it in their personal life, and they're banned from going to ChatGPT at all of their work sites on their work computers, and so security is certainly a very high priority and on the minds of top lawyers and attorneys.
Interesting. Interesting. Well, look, just kind of on to a kind of last section, I guess, just finishing up. And I just wanted to give the listeners, for probably mainly for people thinking about building, looking for investment. You've said you designed this to me months ago. It was a fund that you wish existed when you were a founder or when you were an operator. Like, what does that mean in practice? What does a founder need to show you to get to lean in? We've obviously talked about this in spades throughout, but just to give a bit of a summary here.
Yeah, for sure. I mean, what we look for at a high level is a big enough TAM. And you asked the question earlier, what does an investable to we're generally looking for a $50 billion TAM. That's kind of the line that we're looking at, and there's some back of the napkin math that flows into our fund model as to why we look for that. But really, number one for us, investing at the pre-seed stage primarily is it's all about the founder and the founding team, and what is their unique insight and right to win in this market? Why are they the best founder in the entire world to be going after this idea? Back to my comment that competition is one of the greatest risks in most of the deals that we're looking at, and it's never been easier to get started, but competition has never been higher. And so having a real crisp and clear reason as to why you're the best in the world to be going after your idea is super important to us. And then you got to have the compelling wedge, the interesting market that you're going after, and that story about how you can expand from that initial wedge and grow into a system of record and eventually a system of action over time. And that's generally at a high level what we're looking for. And then as far as TipTop and building the firm that I wish existed when I was a founder and operator. We have the go-to-market expertise. We've been in your shoes. We have the empathy. We've seen the movie, and we know how to lean in. And I think also as almost as importantly is we know when not to lean in, and we're not over your business. And so I like to say to my founders, we 100% are definitely a value add firm and aim to be one of the most valuable dollar or per dollar invested on the cap table. At the same time, though, we don't want to be overbearing, and we aren't strict and making our founders do anything per se. And so I like to say we're willing to be as hands-on as you like or as hands-off. Now, 9 times out of 10, the founders are super excited to partner with us because of our value add, and that's why we're getting into the deals and why they want to partner with us, and have amazing case studies and testimonials from pretty much every one of our portfolio founders, raving about the work of where we're able to lean in on the go-to-market front, specifically on the marketing front, helping with strategies. This week, just met with a port co-founder for a half day in-person session, helping her put together their next year go to market plan, talk about key executive hires, come up with those job descriptions, come up with a hiring plan, um, lean in, be a part of the interview process with those executives, potentially help sourcing, make introductions to amazing recruitment firms like yourself. And then we'll also help with fundraising support and strategic planning. What are we seeing in the market? What are we seeing on terms? What standard? What are the best firms? Who can we make intros to? How do we put the best table or the best people around the table for you to go raise your super successful Series A? And so yeah, we that's what gives me a ton of joy. That's what I enjoy doing is really leaning in with these founders and being able to see some of the impact that our advice or thoughts or feedback is having on the success of these companies is super rewarding. And it's been a lot of fun.
Love that. Love that. Well, Nick, you're one of the few people that scaled from zero to multiple millions. You're now back in the next generation of vertical AI founders, so really appreciate you coming on As a final question or two, like what's one start? I was kind of wondering, you've made a lot of investments with TipTop and previously. Is there any companies that you kind of look back on and think, "Fuck, I wish I invested in them earlier"?
That's a great question and a hard one to answer. One that I'll bring up that I'm very grateful and proud to have invested in at the very earliest stage, pre-product, pre-revenue, is one of our portfolio companies, GCAI, that you mentioned back at the beginning of the call in the legal tech space. Absolutely crushing it for in-house legal counsel right now, scaling extremely fast, and we were able to win our allocation into the pre-seed round at the earliest stage there. And they were one of those high flyers, skipped their seed round, ended up going straight to their Series A, and we'll likely raise a massive Series B sometime here in the future. And yeah, it's an interesting question for sure, and there's definitely some that we've wish we would have pulled the trigger on along the way as well.
Final question: best advice you've ever been given as an operator?
Ooh, that's a really good one. Best advice I've ever. I'll take it back to when I very first joined Greenlight Guru and our founder CEO David Duram, putting such a focus on culture and building that alligator blood culture and solidifying the mission, vision, values early, as a young, high flying founder that went to business school and was very strategically minded, left-brained, analytical. I thought the old adage that culture eats strategy for breakfast was a bunch of BS, having not scaled a company at that point. Now, having lived through the nearly decade at Greenlight Guru, I could not agree more with that and believe and recommend that all founders should be thinking about their culture and treating like a product from the earliest days of their company, just like they do their product.
There you go. Great segment to finish it on. Nick, thanks again for coming on, man, and giving the time. I know you're super busy. There's a lot of activity going on your side, so again, really appreciate the time.
Yeah, grateful for having me on, Gavin. Really appreciate it. Enjoyed the conversation, and hopefully there's some good nuggets in there for your audience as well.
No doubt.